Well, just recently, Ernest, we've had a couple of very upbeat, tamer U.S. inflation reports in the producer price index on Thursday, the consumer price index on Wednesday, that really pivoted the gold and silver markets because there is a sense now that the Federal Reserve may be nearer the end of its monetary policy tightening cycle because inflation appears to be under control and in a downward trajectory.
Inflation in the United States slowed in June 2023 as both the Consumer Price Index and Producer Price Index showed encouraging results. The CPI increased by 3% year-over-year in June, down from 4% in May. The PPI rose by 0.1% month-over-month in June after falling by 0.4% in May. Jim Wyckoff, a Kitco market analyst, said that the encouraging results from the CPI and PPI could help to support the gold and silver markets. The Fed is expected to raise rates by a quarter point in July. However, recent data suggests that inflation is slowing down, so it is unclear if this will be the last rate hike. Federal Reserve Chair Jerome Powell has mentioned that the majority view is that 2 more rate increases will be necessary. Wyckoff highlighted that there is a belief that Fed might raise U.S. interest rates by a quarter point at its late July meeting. The value of the dollar, as measured by the dollar index, decreased by 0.12% to $99.832. Wyckoff expressed that the U.S. dollar has reached a 2-month low is seen as good news for investors who are bullish on commodity markets. The Fed is likely to continue raising interest rates to address inflation, but the current cycle of tightening monetary policy is nearing its end. Wyckoff suggests that the Fed's apparent pivot towards a slower pace of monetary tightening has influenced the prices of gold and silver. Currently, the price of silver is not performing as well as gold. Silver prices are trading at $22.68 per ounce, which is a 2% decrease compared to the previous trading session. Wyckoff believes that silver market tend to go through cycles of ups and downs. Let's watch snippets from Jim Wyckoff's interview, but before getting into the video, make sure to give this video a big thumbs up and subscribe our channel.
Well, Ernest, we've seen a solid rebound in the gold market and a strong rebound in the silver market. This pivot is based upon notions that the Fed is probably going to raise U.S. interest rates by a quarter point at its late July meeting, but then may pause or even stop depending on the new information on inflation in the U.S. economy that comes out in the coming weeks. But right now, there's a growing notion in the marketplace that there may be only 1 or 2 more small Fed rate hikes before this tightening cycle is over. That's good for the U.S. economy. That's good for the world economy. It suggests better demand for raw commodities. It has pressured the U.S. dollar index. And as those who follow the gold and silver markets closely know, the dollar index and the metals tend to trade in opposite directions on any given day. So the fact that the U.S. dollar index has just hit a 2-month low, that's good news for the commodity market bulls. Well, Ernest, that safe haven bid that we saw based upon a weakening global economy, that kind of left the marketplace some time ago. The marketplace now is focused more keenly on better economic growth worldwide in the major economies, producing better demand for gold and silver. Now, the one caveat I will throw in is that we got some weak import and export data coming out of China just recently that suggests the Chinese economy is still, struggling to grow. So we'll have to watch that closely. But as we speak, the marketplace mood is upbeat about some stronger U.S. and global economic growth in the coming weeks and months. What is new is the apparent Federal Reserve pivot or the end of the tightening cycle, and that's gotten into the gold and silver markets. Silver is a poor man's gold, so to speak. And I think what we're seeing also in the silver market, it's playing a little catch up just on some better demand. It's cheaper to purchase. So we're seeing prices. In fact, we hit a 2-month high in silver late this week, and the technicals have turned bullish for silver, suggesting more price upside in the near term. Well, remember, Ernest, that commodity markets are highly cyclical, and we just in the past several weeks or few months, we've seen a down cycle in silver. We're starting to see that turn. So it's not going to be surprising at all to veteran market watchers to see those cycles kind of reverse course and see some price uptrends in place in the raw commodity market.
U.S. stocks experienced an increase in value following the release of new data that raised hope regarding the Federal Reserve's ability to control inflation without causing a recession in the U.S. economy. The S&P 500, a key stock market index, reached a new high for the year 2023. Wyckoff believes that there is a perception that there is more potential for the U.S. equities market to rise further based on bullish technical indicators and improved fundamentals, as it appears that a strong recession may be avoided or might not be as severe as previously anticipated. The main stock indexes on Wall Street, which are indicators of the overall performance of the stock market, further built upon the gains seen on Wednesday. This was driven by the release of data showing that consumer prices had a modest increase in June, marking the smallest annual rise in over 2 years. Wyckoff highlights that, at present, there is a growing belief that the U.S. economy will experience a gentle landing in the upcoming months, indicating a smooth transition and recovery. Let's watch Jim Wyckoff's interview with Kitco News.
The U.S. stock indexes just this week hit new multi-month highs. So you're starting to see this, and just actually the past, late this week, we've seen the markets move still higher. So that is based upon notions of a less hawkish Federal Reserve, maybe less hawkish other major central banks, again leading to more demand for paper assets like the equities. So I do think that there is more upside in the U.S. equities markets. The technicals are bullish, and the fundamentals have turned more friendly, given the fact that it looks like we are not going to have a strong recession if we have a recession at all. Well, it looks more and more likely. In fact, this has been the most broadly forecast economic recession that's never happened. And it appears that we are going to be able to navigate the economy, the U.S. economy, through this without any serious damage. And even if there is maybe a mild recession, that's all it's going to be is mild, but the jury's still out on that. And it appears right now that we are going to come in for a soft landing for the U.S. economy in the coming months. I see a steady climb. There's an old market adage that goes, the stock market's like to climb a wall of worry. And indeed, you can argue that's what's happened the past few weeks as the stock indexes have trended higher despite hawkish rhetoric coming from the Federal Reserve. So the fact that maybe the Fed is going to ease off on its tightening cycle sooner than many expected just last week, I don't think that's not going to unleash any super buying fury in the stock indexes. What I suspect we'll see is a continued steady to sideways or steady to higher grind in the near term. We're heading into August, however, and that is typically a slower time for trading in many markets, including the stock markets, because a lot of Europe is on holiday during August. So you may see some languishing dog days of August type of trading in the coming few weeks. I think the rubber hits the road after the Labor Day holiday. Traders get more focused on trading instead of family vacations and such. So I think the month of September is going to be extra important for the stock indexes, and it could very well be, and history has shown this, that we may rally. Remember that markets like to factor in expected fundamental events before they ever fully play out. So even as we get good news, potentially good news in August and into September, that's probably will have been factored into stock index prices. So you may see what typically turns out to be bearish months of September and October for the stock indexes. That's history shows that. We'll see if that plays out again this year. Wouldn't be surprised if that happened.
Gold prices slightly increased on Tuesday as the dollar weakened. Traders were awaiting retail sales data from the U.S., which could impact the Fed's monetary tightening plans. Although the upcoming Federal Reserve meeting might temporarily reduce the attractiveness of gold, OCBC Executive Director Christopher Wong suggests that the Fed is nearing the end of its tightening cycle. With the Fed expected to raise rates by a quarter point in July and inflation showing signs of slowing down, what do you think the future holds for the stock market and precious metals? That's all from us. If you like this video, please like, share and subscribe our channel and click the bell icon to be notified of future videos.